Well, the housing market is, of course, something we'll be looking at pretty closely, because so far we've seen a very cautious response by householders back into the housing market. We expect that to gather a bit of pace, but still to remain quite cautious. Complicating behaviours in that has been the tax changes in the budget. Some people were expecting that to happen and may have already built that into their behaviours. On the other hand, we've yet to see exactly what that does around rental housing, owner-occupied housing investment, house prices, and property investment generally. So we'll be judging that as we go. We do see householders saying they want less debt on their balance sheets. We're going to be watching that one pretty carefully as well. Now, pushing up interest rates starts to make it more attractive to save in relative terms, less attractive to borrow, but at very, very low rates still. So overall, over this next year, we will continue to have very stimulatory conditions.
Do you have a specific forecast on house prices?
Yes.
So thinking over the decline in house prices, we lost about 10% on house prices. You'd expect that that 2007 peak would be recovered sometime early next year. In real terms, prices declined by about 15%, and we wouldn't expect that to be recovered over the projection. Yeah.
Now, house prices have been a very dominant feature driving a lot of behaviours in the New Zealand economy up into the crisis. We don't necessarily expect that to be such a big driver as we go through recovery. It's more a rebalancing story.
And just to clarify, in nominal terms, house prices, what sort of picture going forward then?
So we've got modest increases, so nothing more than 1 or 2% annual increases, so quite modest.
Do you see any signs of banks' access to credit on offshore markets easing, just even in the last week or two?
Well, over the last couple of months, as the Greece debt crisis has rippled around world markets, access to term funding for banks internationally has got very difficult again. Now, this is something which opens up and closes up from time to time, and it has changed depending on the news at the time. So, over the last couple of months, there's been times when banks have reported back that access to term funding has closed down again and then opened up and then closed down again and so on. We're not particularly concerned about it at the moment in the Australasian system because the Australasian banks are well funded, and that's partly a result of the quick actions that we took during the crisis to push up liquidity requirements. We can already see that on bank balance sheets. They're in a more comfortable position in New Zealand and in Australia. So we don't have any particular concerns at the moment. But we are pulling out of a very nasty global financial shock, and there has been bad news in the recovery, and there'll continue to be volatile news in the recovery, so we'll keep watching that.
Given the pressure that those sorts of problems might be putting on banks' funding costs, did you give any consideration to perhaps keeping the rate on hold today and perhaps delivering a 50-point increase at the next review or the review after that if the storm started to look like they'd passed and inflation was becoming more of a problem?
We watched the financial story pretty closely, but in answer to your question, no, not specifically. We have a situation in New Zealand where we have an extraordinary amount of monetary stimulus. We're looking medium term. We're looking to make sure we're back on track so that by the time you start seeing a couple of years of recovery under our belt, we are in a position where we don't have inflation beyond the target range. So it's been very much a medium-term story. Now, if short-term financial events really bubbled away such that they impacted the medium term, then we'd take that into account.
You seem to have a fairly gentle tightening track going out. Would that be correct? I mean, is it possible you might hold off a rate rise next time and have more gentle increases?
Well, we've got this track which is removing stimulus, and as I said, that's the main story that we're looking at the moment. We'll keep reviewing it. So if we were to see financial market impacts having a real effect there, we'd take that into account. I mean, it's an incremental story. Each time we'll look at the decisions on their merits. There's no guarantee that it increases at 25 basis points over the next year. We'll keep looking at that. We're in quite a good position from that point of view. We've got a lot of stimulus out there. We will for quite a little while. We can, however, we think by moving now, have the luxury of taking our time to make a judgment each time on its merits.
Does the exchange rate, in terms of effect on stimulatory or non-stimulatory conditions, what impact's that been having?
Oh, well, as usual, the exchange rate's very important for our forecasts and for New Zealand economic futures. Of course, we haven't moved around that much over the last little while. The story this time has been very weak euro and corresponding bit more US strength. Actually, the Australian dollar has been a lot more volatile than the Kiwi dollar over the last little while. You'll see our projection is for gradually softening New Zealand dollar. That depends on a number of things. Yes, that can make a difference.
You've mentioned that bank funding costs have increased. Could you have allowed those increase in bank funding costs to do your work for you and not have to have increased the official cash rate?
Yeah, we already actually have had those bank funding costs do some of the monetary policy work for us over the last year. Actually, of course, we've been growing for a year. We've had reasonable growth for a couple of quarters. And over that time, there has effectively been a bit of a tightening put in place by those bank funding costs. So we've certainly taken that into account.
Tax changes in the budget in the end were easier on residential landlords than they might have been, and rather harder on the business sector than many expected. Is that a helpful or an unhelpful mix from your point of view?
Well, I'm not sure there were really net surprises from the budget tax changes. I mean, the important things out of that for us were, first of all, a tightly controlled and transparent fiscal track. That was really important, given where the markets are on sovereign risk. Secondly, a story about net fiscal stimulus, which says, well, there still is some stimulus through this year, and then it tightens away, and that broadly looks like it's useful and fits in with monetary policy as well. And then thirdly, these particular tax changes that have changed the relativities of incentive for investment in property, in residential property, and in owner-occupied. And I think people had broadly forecast what was happening, so we haven't felt there's been a lot of surprises in that, but we've yet to see just what impact that has. And you can see our view on that. It's in our forecast. It says gradual recovery in both business investment and the housing market. We also note, of course, that the income tax reductions do compensate for effectively for price effects through GST. So we wouldn't expect though the GST increases to lead to wage demands off the back of them alone.
But it's not just the GST increase alone. There's all the other government charges that you point to, and an underlying inflation rate that the bank has said is being contained but not crushed by the recession and so on.